We are live. Shateka Husser here, coming to you once again, talking about the 10 reasons to own life insurance in a recession. Want to be really, really quick tonight. Coming on a little later than normal because we have quite a few distractions just beforehand. I mean, it happens. But we want to be consistent on Wednesday evenings at some point, anywhere between 8 p.m. Eastern Standard Time and 9 p.m. Eastern Standard Time. And so we're going to jump right into the content tonight. Again, I'm Shateka Husser, CEO of Husser Financial Solutions. We'll be helping you retire before you expire. So if that's what you desire and what you aspire, we are the ones you hire. Our goal really is to get your bank account on fire with a whole lot of lifetime tax-free retirement income that you will not outlive. I know that was a mouthful, but our goal really is to see you not have to return to work in poverty in your 70s and your 80s because you are outliving your money. Just on today, I spoke with a gentleman that's 80 years old and looking to see how he can stretch his money because people are just living longer with advancements in medical technology. And so our goal is to make sure that you outlive your money. All right. So, it's 10 reasons is what the name of this is, but we're going to talk about maybe more. We'll see how we do on time tonight. The income for your loved ones, of course, is the number one reason that most people get insurance, life insurance. But the reason why it's called life insurance instead of death insurance is because you can actually use several benefits while you're living, more than what we'll talk about tonight. But we want to never be too long. We only want to be strong, and we never want to be wrong. All right. So the number one reason, of course, is to use it for some type of income replacement for an individual that passes away. So a lot of spouses may, decide they want anywhere between 3 to 5, some 10 to 20 years of grieving income so that their spouse can be able to grieve properly, or their loved ones could grieve properly during so many years of them being gone before they have to return to the workforce, full force, and continue on with their life. But beyond that, there are many people that say, you know what, I don't even have anyone that I want to leave my insurance policy to. I don't have children, I don't have spouse, whatever the case may be. I don't have anyone that I think is worthy of being a beneficiary of my money. And so that be the case, there are lots of reasons why you can still own your policy and leverage it while you're living and live your best life now. Because I believe that life insurance is really for the individual to live a lifestyle of freedom, financial freedom, time freedom, location freedom. Life insurance it affords all of us that opportunity. I have a few policies myself. I love my policies. So I could talk about the different policies because I use them. I am what they say, a user of my own product. I get high off my own product is what people say, right? Whenever they use the product. So at the end of the day, compounding cash value is probably the number one reason most people get a policy, because they want to make sure that their money is working for them while they're sleeping. They don't want to have to work too hard for their money. I know you say, well, it's not the fastest growing item in the world. But when you look at the fact that you're not paying any taxes on the income that's growing inside of that versus other types of financial assets, it absolutely competes, because there are policies that have done up to, I've seen 28% in terms of how well it's performed, index products as well, right? So the goal really is to see how you can, get into the right type of product that's going to be able to be used. And it's really about how that policy is structured. So a lot of people look at, some of these advisors as money hungry. They're just trying to sell you something. They just want to make a fortune. But you can actually structure these policies to such an extent to where it's literally 70% cut and the individuals pay. How you doing, Sean? So at the end of the day, the goal really is to make sure that it is what the client needs. It's not about me or, the financial advisor. It really is about, what does that client, what's their vision? What is the outcome that they're looking to produce out of that policy? What are they trying to use that for, right? Because there's so many different reasons that people use policies, and actually each policy could be a different home that they're trying to make sure that they purchase out of the policy, or a different, bill that they're trying to pay off, or whatever the case may be. But at the end of the day, the goal is about you, the client, and not the actual insurance broker or captive agent. And of course, the difference is that a captive agent works for like New York Life or Primerica or, all state, State Farm, things of that nature. But at the end of the day, a broker is one that has access to, several different, A-rated carriers to be able to get you the lowest rate possible for your budget to get you the most amount of benefits for your money. That's what a broker ideally would do differently than a captive agent. And so it really depends on that individual that's getting that policy to determine how we're going to get that thing structured, right? So our whole life, debt payoff or emergency fund policy is different from, say, an index universal life, retirement income type policy. The way they're structured is going to be totally different. And so you got to be real clear about that. So ideally, if you want cash value, it's going to be structured differently than if you want death benefit. And so the main thing that most people don't even understand is how much death benefit do they want to have, right? That's the number one question most people don't even understand. So if they do want the death benefit, what does that look like? Is that properly, are you properly insured or are you underinsured? And then if you don't really care about the death benefit and all you care about is cash value, of course, it's going to be more favorable for the individual that's looking for the cash value, not necessarily for the person that's giving them that policy or selling them that policy, because the death benefit is how, just in all honesty and just being very transparent, the cash value is how, I should say the death benefit is how the agent will be paid off of in most cases, right? With those different carriers. So it really is up to that individual that's filling out that needs analysis, that client is looking to apply for that carrier, more so than it is for the individual that's actually selling, right? So that's super important to understand and know. Now, so that's number two. Like number one is death. Of course, making sure you have that income for that individual that's going to be leaving. Number two is going to be primarily that compound cash value that's growing regardless of what you have going on yourself. You still have that money growing for you in the background without any market losses. Different from stocks, different from mutual funds. It's going to be able to help you to still have some type of balance. In other words, you don't lose any money like you would in those types of accounts. So that's why a lot of people turn to these safe havens of types of insurance policies, rather it be, IUL or whole life or some type of annuity. They want to make sure that they are risk-free. Even the gentleman I told you about that I spoke to yesterday that's 80 years old, he doesn't want any losses in his account, right? For example. All right. So number three, tax-free growth, right? So it's not about how much money you make. We always hear people say it's how much money you keep. But the same thing when it comes to how you contribute your money. Do you want to have your money growing for you tax-free, or do you want to have your money growing for you having to pay taxes when it's all said and done? Because we already know that based on what's going on in the market today, taxes are going to be significantly higher in the future than they are today, right? So understanding that, would you rather pay your, taxes today on the seed or later on the harvest, right? That's super important to realize. And most people don't want to pay on the harvest. They want to pay on the seed. So they want to go ahead and get this thing turned into a Roth type of account or some type of tax-free account or some type of life insurance, permanent cash value policy where they'll be able to have that money grow tax-free for them. Super important. All right. And then number four, living benefits. What's going to happen to you, no matter what type of account you have, if something happens to you with chronic, critical, or terminal illness, heart attack, cancer, stroke, dementia? What are you going to do differently so that you don't consume all of your funds that you have saved on a medical bill or have it, hit your credit report or things of that nature? How are you going to tackle that? All your bills, in other words, if something happens to you medically, right? So for the qualifying illness, you can actually tap into your death benefit, 80% of it, depending on the carrier, to 100% of whatever your death benefit is, to be able to use while you're living to offset some bills that you may have occurring as a result of your illness. So that's super important to understand. Now, everything that you have, it can be taken if there's some type of lawsuit. But this is why the wealthy put their money inside of these types of policies, right? They don't want anybody coming for their money, right? You cannot touch it because it is not visible in a court of law, right? What's inside that cash value. So this is a great way to protect your money from lawsuits, protect your money from taxation, protect your money from market volatility, right? So very, very important that you understand that. Now, number 6, you want to have full control, right? If you have retirement funds, you don't have full control. Let's just be clear about it. So that's the reason why a lot of people, they want emergency, which is probably 6 and 7, emergency fund, right? In event of recession, or, having challenges with not being able to work, you can access that cash value to offset some bills, and the money is still compounding inside your account as if it never left. However, of course, at some point you'll end up paying some interest on that, which is usually still going to net you more than you would ever have inside of it, a bank account. If you had those same funds in a bank account, no matter what, 9 times out of 10, historically speaking, okay, past results don't equal future results. But what we have seen is you're still going to do a whole lot better with the funds being inside of your cash value account taken out as a loan than you ever will have it sitting in a bank account. So it's something to think about. This is why there's BOLI and there's COLI, bank-owned life insurance, corporate-owned life insurance, because corporations realize this is a wonderful way to put their money into reserves. And of course, banks the same. That's why the successful banks, they have really good reserves in these types of accounts, right? All right. So number 8, you want to make sure that you have something that supplements or replaces your Social Security, because we don't know if Social Security is going to be around. Between 2025 and 2032, economists say, and just recently I read, again, 2033 is really the year that they're looking at hard, where there will not be Social Security. If that be the case, what are you going to do? Are you going to have some type of supplemental income? Or are you going to have something to replace it if it's not there? What are you going to do? What is your plan? That's the question you have to ask yourself. So when you go to Shateka.com, you can actually see that there is a retirement planning guide. It's going to give you some information. But when you go to that page, you get that retirement guide. There's quite a few questions that you have to ask yourself that you may not have considered around retirement and making sure that you're prepared, right? So I'm gonna put that up there, right? Want to make sure you do that. Number 9, it really is less fees, right? When we look at the numbers, 30 to 50% less fees. When you look at, some type of permanent cash value product versus some type of, stock or mutual fund type product, it's going to be less fees, 30 to 50% less fees. And that's important for some people. Other people, not so important. But the wonderful thing is that, you have this access to this, what I like to call this leverage vehicle, until you're age 120 in most cases, depending on the carrier, right? But a lot of people are using these for debt payoff. So I think that's the final one that we'll talk about it and I'll be done, is that if you have debt, no matter what debt you have, you can structure these policies to pay all of your debt off. I don't care if it's a mortgage, a student loan, I don't care what the amount is. You can structure the policy to pay off all of your debt between 7 and 9 years. 7 and 9 years. Very important to know, because if you're going to pay the debt off anyway, you could actually kill 2 birds with 1 stone, have cash value building in your account at the same time that you're paying off the debt. So this reserve account, your bank account, in the form of a whole life policy, ideally, all right, because you can have access to more cash. There are some IULs I just learned that are 90% cash value in the first year, which is super exciting. So I'm in the process of adding that to our client portfolios for, if they want an IUL, they can still have access to more cash. I love that product. So it depends on the individual, what they're trying to do, how much money they have in reserves. IUL is not for everyone. Term is not for everyone. Whole life is not for everyone. It's really what is the client's concern? What is the client's vision? How much budget does the client have? And that's what we're talking about today. So if you have any questions, definitely reach out to us. We don't have a lot of slots left for September. Not many slots left for quick consultations, but this is Life Insurance Awareness Month. We definitely want to be talking about life insurance all month long. You'll be seeing some of if you follow me on social media, you'll be seeing more about life insurance this month than you've ever seen me post about life insurance specifically. But the goal really is to educate. There's just so many people that are not, they have no sense of urgency when it comes to it, when it really is the foundational item that you need to have inside of your retirement account. If you're going to be looking at retirement, or you're looking at financial freedom, all those things, it is the fundamental building block for you, because at the end of the day, there's nothing else. There's no other type of financial class that's going to be able to allow you to have all 6 steps, the common denominator for all 6 steps of financial freedom, to be in that product. If you look at stocks, you look at real estate, you look at crypto, you look at anything else that you can put your money in, none of them have all 6 steps of financial freedom. And that's all we're saying when we talk about, having it to be a part of your foundational financial vehicle. All right, so we are done speaking for this evening. Definitely want you to take notes of what we've already said. Think about those quick things. We'll be back on next Wednesday, somewhere between 7 and 9, ideally. Maybe 9 is what it's looking like, closer to 9 than it would be 7. But either way, go ahead and subscribe, click the like button, all those good things. And we just want you to know when we're going live. But it is going to be ideally on a Wednesday evening, so that we can have some more consistency around when we go live. Thank you so much for joining us tonight. We will see you on next Wednesday. Have a great night.